one thing I do want to talk about is the difference between spot and contract. So the spot market is what dominates sentiment. It's the price that we see listed, it's the price that gets quoted, but in reality, very little uranium is actually sold to utilities in the spot market. It's actually not even the correct name. So it's not even a market. So the spot market in, say, in nickel and copper and gold is a true market. It's an open market where it's a trading house where the metal is traded openly, and it's a supply-demand economic. The spot market in uranium is not. It doesn't work like that. It's actually an arbitrage market. So the spot price should actually be called the arbitrage floor price, because what's happening is after the big uranium run-up of the price in 2007, a lot of traders entered the market, and these are arbitrage traders. And arbitrage is just simply buy low, sell high. And for that to work, they absolutely have to pay the lowest price possible for uranium, and then they get enough uranium that they can actually sell into a contract. So they're competing with miners. So what happens is the spot price that you see is actually, it doesn't reflect the average contract price that's happening around the world. And most utilities buy on contract. But what has happened is, over time, since 2007, we can actually see that there's always been a delta, or a difference, a positive delta between the spot price or the arbitrage floor price and what's called the term price, which is basically a long-term contract, not an average of all long-term contracts. There's always about a 20% difference. When we see a spot price of, say, $30, you know that the contract prices are being written at 50. Right, and the last time we saw the spot price ramp up, people were locking in contracts at 60 and 70. So what's important for your viewers is to understand that the spot price is an artificially low price. It's based on traders trading amongst themselves, trying to make a margin between buying it low and selling it high, but doesn't reflect the contract price. The contract prices, unfortunately, are confidential. But what we do know is that by and large, the contract prices are almost always 20% higher at a bare minimum to the spot price. So right now at a spot price of, say, $25, we know that we could go get contracts today at 40. But that still doesn't sustain global production. When you look at the all-in sustaining costs of global uranium production, as you would with any other commodity, the marginal cost of production for uranium is 55, right? So anything below 55, but they're being sustained by long-term contracts, right? So nobody sells into the spot market. If you were to say today, let's say we have no more contracts and we just have a spot market. Well, at $25, 2/3 of the world's uranium would close down, right? So the point is that the spot price, while it drives sentiment, is not important. What's important is what will the contract price I get in 2023 when I start production. That's what's important. And so, unfortunately for us, we need to announce a contract to prove that will be the case. And that's certainly where we're putting a lot of our effort.